everybody. Welcome to the podcast. It's a Sunday evening edition, and the weekend just kind of got away. I wanted to do one yesterday, but regardless, you're getting it here before the week starts. Well, the stock market finished the week on an up note. Dow Jones up about 70 points, the S&P up about 5. NASDAQ was flat on the day, and the Russell 2000 was actually negative. So it was really probably a weaker day than what it first appeared. You know, you see the Dow Jones printed on the news, and you think the market has done pretty well. But the market's not all about the Dow Jones. It's not all about the S&P 500. It's about the bond market, commodities market, interest rates, volatility, international bonds, not just international stocks. All of those things are the investment world. And what we saw Friday was a good example. The Dow Jones up 0.5%, looked very strong. Then when you dug down into the numbers, you started to realize that small companies did very poorly on the day, the Russell 2000, and mid companies and the NASDAQ all were weak. And really what we want in a strong market is we want the riskier things to be the things going up and the safer things lagging behind, so to speak. And in the last few days, that's not what we've seen. Now, you can see the Dow Jones Industrials here. And, you know, the one thing that sticks out to me is that, yes, maybe splitting hairs, but we aren't getting all the way to the top, and we are starting to break through the bottom into this range. And then if this was the top, you see it's a slightly lower than the last time. You know, so we're going to get something that drifts down and goes down a little lower. And now you're starting to get these lower highs. That's a concern. But for all intents and purposes, the stock market rallied to the top and is now pulling back. Now it's stretched. In a newsletter I sent out to clients, I called it Plastic Man. You remember the old character, Plastic Man, the old comic character from the 40s and 50s, and I think reintroduced in the 80s. Plastic Man would stretch, and just when you thought it was going to snap in, he stretched a little more. And that's what the stock market feels like. It's stretching, and it doesn't mean that it has to, pull back in. The stock market can continue on its way. And I think it will, but I think there's definitely some shorter term concerns, some things that we need to look at, and we'll go through those. And you can see this, the S&P looks a little different than the Dow Jones, doesn't it? The S&P actually went up to new highs, so as opposed to going up to the old high and failing, it actually broke above. Now, if any other chart, you would look at this and say, okay, it's going to come back down, maybe test that, and then off to the races. That would be great if you own stocks. But it's too early to tell if it's going to do that. It's still stretched regardless of how you look at it. When you look at the Russell 2000, this is what's getting a lot of pub the last few days, is the Russell 2000 has been falling. Not only has it been falling, but compared to the S&P 500, it's losing strength. Take a look at this picture in the middle here. This is the Russell 2000 compared to the S&P 500. And so all during this rally from May, we were getting an outperformance. So this shows that it's outperforming the S&P. And now what you're seeing in the last few weeks is it's starting to underperform. And it's just starting, but it is something to watch. The Russell 2000, again, where it has bounced is in between the 50 and 100-day moving average, puts it right in there somewhere before it would potentially bounce. Now, here's the deal. Let's take a look at a couple things. Here's the oil picture, and commodities as a whole have been kind of breaking down lately. You can see oil had reached a pretty nice double top here. If we go back to February of 2012, which was around $110. So it came up there, failed miserably, went down to the high 70s. Then we spent a lot of time over the next year and a half working our way. Started to have a little bit of kind of congestion in here where it had trouble, got to 110, lo and behold, it's heading straight down now. I've drawn this little yellow box. This is kind of what I would envision to be the target area, just based on this uptrend it's been in. And if it breaks that, then I think we've got some bigger issues in the whole economy. Because the thing about what's happening right now is every place I go, people always ask about and talk about inflation. When are we going to get inflation? The gold market's been signaling that we're not getting inflation, right? If they were signaling we're getting inflation, we would be going up, not down. And gold has fallen from, I don't know, 1,700 and something an ounce to 1,300. So it's been signaling not necessarily deflation, but not inflation. But the thing is, everybody worries about inflation because of what the Fed is doing. And I've talked about this before, how the money that the Fed is printing and putting in the banking systems hasn't been released into the economy. And that's why we're not getting inflation. We're not seeing that velocity of money pick up. Maybe we will at some point, but we're not right now. The bigger concern is that we get deflation, because inflation is something that can contain itself over time, right? When things get too overly priced, what happens? People stop buying it. That's what happened in 1980, 81, until interest rates got to this peak and started to come down. People literally, at the beginning, they started to buy a bunch of things because they knew it was going to be more expensive in a month. And so they ran out to buy more. But it got so expensive that they just couldn't buy it and you couldn't afford it anymore. The bigger concern than inflation is deflation. And that's what we saw in 2008. And that's something that it's very hard to for anybody to do anything about. It has to run its course. So if oil starts to break down significantly here, and that's really what the Fed's main concern is, not to take their side, but I'm just speaking for them. Their concern is deflation, obviously not inflation. But if we start to see oil break down and get below, let's say, $92, $91 a barrel, that would bring in some concerns there. If we take a look at interest rates, they're at a very important inflection point here. Because remember, we had the big run-up starting on May 1st, right, with this big spike. And then we talked about on a podcast how the trajectory is changing. It was starting to slow down. It wasn't rising as fast. And lo and behold, we have had a pullback. And all those income-sensitive things, interest rate-sensitive things, are actually had been doing quite well in the past few weeks. But now, you can see what's happened here. We have retraced this move, 38.2% of this move, which is a very common place to retrace. And now we're at an inflection point. Do we see interest rates start to resume their track higher? In other words, was this just a pause and then we're going to move up higher? Many, many people think so. Or are the economic numbers that are coming out so weak that we're going to bump into this line again and start to head back down, only to continue this trend downward? That would be the logical thing, A, if the stock market got scary enough to make people scared and go into bonds, and B, if the economy was weak. I think the biggest risk we have as investors is interest rates going up and the stock market going down, right? And it may be going down because we have not enough growth and we have some inflation picking up. That would be stagflation. That would be a bad scenario. Bonds would be losing money, stocks would be losing money. This move right here was accompanied by a reacceleration in the economy. And now what you've seen in the past few weeks is a deceleration again in the economy. And so growth is a big deal right now. It's teetering on 1-2%. You're seeing a lot of economists around the world start to ratchet down the growth numbers. And so let's see what happens. Last week was very sporadic. Some of the numbers were weak and some were stronger. But it was enough to spook bond investors, and that's why you saw this little spike up in rates here. Okay. But if you take a look at something like, let's take a look at LQD. LQD is a investment grade ETF. So if you want bonds, and you say, hey, I'll take 3 or 4%, and they're pretty good quality bonds, I can buy them in a basket with an ETF. LQD is your man or woman. I don't know if ETF has sexes, but LQD here, the iShares corporate bond ETF, investment grade. But here's the thing. If you take a look at it, you'll notice it had the big sell-off. And after it did that, it started to stabilize, right? It came down, and now it's moved sideways. It's at the top end, so it had this zigzag pattern. It's at the top end, starting to head back down again. So watch that. Does it head back down, or do we get higher? And again, if interest rates go up and keep going up, this will keep going down. and bonds, which are already negative on the year. Remember, bond investors are losing money this year. They actually have a negative growth rate this year. Bond investors would lose a lot more. So again, look in your portfolio when interest rates are up, see what's doing poorly, and decide if that's what you want or not. I'm not saying you shouldn't have anything that's interest rate sensitive, but you better have some things that hedge it or go up on days where interest rates go up. So it's not necessarily the direction of interest rates that concern us, it's why are they doing that? Are they going up because we have inflation? Are they going up because we have growth? Are they going down because we have deflation? And are they going down because we don't have any growth? The other thing we want to look at is VIX. The VIX, the volatility index, it's on the lower end again, so we are susceptible to a spike in volatility, right? Every time we've hit these levels, this line here has been kind of the floor, and now we're at the bottom again. So at some point, we would suspect that we would spike up and get a fear-based sell-off. And there's a lot of indicators that are showing that we could sell off in the short run. You're starting to see a lot of selectivity in the types of stocks going up. You're not seeing the widespread run-up, right? Financials are starting to underperform. You're starting to see cyclicals like utilities perk up and pharmaceuticals perk up. Staples, consumer staples have been on a tear doing well. Those things. So let's watch that. The market's indicating that there's a little rotation internally going on, and we need to pay attention to that. Last thing is gold. I talked about it earlier. Gold was starting to make a base, and maybe it still is, because maybe we start to see some signs of inflation, but you started to see this decline. I mean, again, just look at the moving averages. Look at the 50-day, which is the blue line. See how it's going down, and now it's moving sideways. So you may still be getting this long-term basing. In our aggressive strategy, we had bought gold miners, the junior gold miners, nevertheless. Those are the real fun ones. Those are the ones that move a lot. And we noticed that, number one, we were down here at a point, this is about where we bought it. We're approaching a double bottom. We were getting some exhaustion indicators that we monitor. We're saying that, hey, this thing's exhausted to the downside, meaning it had run its course and it was going to pop. And it did. It popped. Once it started to roll over and it kind of broke this little trend, we sold a third of our position. On Friday, we sold the remaining. And so we ended up with, I think, a 7 or 8% gain in literally just a few trading days. And that's the difference between an investment and a trade. Some of you may own gold mining shares as an investment for the next 2, 3, 4, 5 years and say, hey, when inflation hits, and boy, when it does, I'm going to make a lot of money. And you probably will. But if you've been holding them as an investment and they've gone from $100 a share right here down to 36, losing 70%, you need to recheck the investments, right? So I think they may be basing. And so it's something, while we're out of them right now, we may revisit this. So what we want to see is that, does this hold? And so it's going to come down here potentially again and bounce, or is it going to fall through? So let's watch that. But I don't think we're done with this trade. But again, it's an aggressive trade. We held it for literally, I don't know, something like 7 to 10 trading days. And it was for our aggressive strategy. So if you want to own gold, you can do it, or you can own gold miners, which is GDX, or you can own the junior miners, which is even more volatile, GDXJ. And so we elected to go with the GDXJ, and it gave us the most juice. And so that was a quicker trade, and that's something that we're out of right now. So let's see what we've got here. We've got coming up, obviously, more economic data. Some of it was delayed because of the government shutdown. And coming up this week, we're going to see more data coming out over the next couple of weeks. And it's going to give a better indication on what this economy is really doing. But the market is signaling something. When you see financials start to underperform, when you see the Russell start to underperform, when you see gold doing okay in the past few weeks, and you see consumer staples doing okay, and you see the growthier type things not, that tells you that there may be an internal rotation signaling that instead of everybody worrying about inflation, maybe they should be worried about deflation. So just keep an open mind there, because inflationary type investments are on sale. Some people are loading up on them, and they've been wrong all year. But at some point, they may be right. But watch what those do over the next few days and weeks. So just be a little cautious here. Take some profits. But again, the market, as strong as it's been, there's been several fakes to the downside. And so, yes, the market appears stretched, just like it was here. but we had a little pullback and then a rally to new highs, a pullback, rally to new highs, pullback, rally to new highs. Again, what is logical here? A pullback, maybe to 1700, and then a rally to new highs by the end of the year. We've got 2 months to go to the end of the year, and I can tell you, if you look back at history, not only from November and December, that those are good months, but if you look back in a year like this has been, the most correlated years to this 2013 year, what you will see is that usually stocks go higher as the year goes on. So you would think, well, there's profits to be made, people are going to take them, and that will go down. Not in the past. In the past, most of the years have continued higher. So just keep that in your mind before you get too bearish. All right, guys, thanks, and have a great rest of your weekend. It is dark outside because of the undoing of the daylight savings time, and it's a bummer. I like when it's light outside. Oh well, it's going to be light in the morning. Take care, everybody.